Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are. Well, it really comes from what the catalyst is going to have to be to get us out of the recession, which is, it looks like it started even earlier than I thought. I'll just say at the outset that although back-to-back negative quarters of GDP isn't the technical official NBER defined recession, it's a Wall Street rule of thumb because it always works. Whenever you've had back-to-back negative quarters, you've been in recession. Whenever you've had 2 quarters down out of 3, you've been in recession 100% of the time. So that's where we are. There's really no doubting it unless you want to attack the historical record. But you see, the reason why I think it's going to be long is because it's already started. And so once we acknowledge that we're in a recession, and I think it's going to take the consensus some time, because when you really look back, say, to the great financial crisis, the recession wasn't acknowledged really until Lehman collapsed. The view was that it was a soft landing. And you go back to the tech wreck, and people were surprised that the NBR actually called it a recession that started in March of 2001 and ended in November. The bottom line is that once you get into recession, you need a catalyst to get out. And there is no catalyst from fiscal policy. Fiscal policy continues to operate in a way that is contractionary for the economy. So the question is going to be, what is the catalyst? And I think ultimately the catalyst will be a move back to disinflation that gives the Fed the opportunity to ease monetary policy. But that's not going to happen immediately. The Fed has been tightening into a recession, which really only happened during the Volcker era in the early 1980s, when you had back-to-back recessions separated, a year apart. You could almost argue that that whole period was about a 3-year recession.
So one of the things I've looked at is that the markets and the commodity markets, so I created an indicator of rate of change of rates, rate of change of commodity prices, rate of change of the dollar. And we've had one of the largest, sharpest tightenings in all history, regardless of what the Fed, right? The markets kind of did it for us, and inflation did the rest. And that, when I look at that, it gives me kind of ISM getting down to 35. Now the question is do the Fed even matter? Or will the markets price test? Because, I think the bond yields start falling and eventually the yield curve starts steepening again. And the equity market seems to sense this. Now, whether it's too early or not, different matter for sure. But the point being is, do we even care about the Fed, or will the bond market be the truth?
Well, it's like the chicken or the egg. The Fed is extremely important. Without the Fed, there's no recovery in risk assets in March of 2020. Okay, so just as an example, without the Fed, I started in the business on October 19th, 1987. There's some of us, I think, that would remember that day. There's just an absolute cataclysmic decline from those levels without the Fed. But the thing is that, look, they made it very clear that inflation is number one priority. The real economy is number 2 priority. At some point, that's going to shift. They're going to cut rates, re-steepen the yield curve, but the recovery's not going to happen overnight. It's going to take some time because the recovery takes place really after the last rate cut. So, Raoul, what time frame are we talking about? Like second half of 2003? And then the stock market will see it, call it 3 months before it happens. So maybe the lows will be in the mid part of next year. But we're in a recession.
Is the Eurodollar curve wrong then? Because the Eurodollar curve suggests that the Fed starts cutting first quarter. 23.
I think there's a good chance that that will happen, but it's going to be too late. I mean, so the futures strip is telling you they're going to start to cut interest rates. At that point, I mean, think about what you just said, that the Fed will start to cut rates. The markets have the Fed cutting rates a year after a recession starts. And I don't think Paul Volcker even waited that long. So you see what that means, that they're going to be so late. The corollary is they're going to be so late to ease. That's why this is going to be a really long recession. They're going to be very late. They're going to be very late to ease interest rates. As far as the economy is concerned, I mentioned that they're not going to cut rates till the first quarter of next year. And then when do the recoveries usually start? Is more than a year after the first rate cut. So the recovery doesn't start till 2024. You know, what's amazing is you have economists there saying the recession is not starting. I had Megan Green on my webcast yesterday saying that the recession is going to start in the second half of next year. I went, what? I think second half of next year, well, I think by the end of next year, we'll be talking about the recovery. But you see, that's what's problematic here. The Fed is following lagging and contemporaneous indicators. They're freaked out about inflation. And they're still tightening into a recession. And the market's telling you, yeah, and they will not respond to the recession until the early part of next year.
So you're counting the recession starting beginning of this year. So therefore, by the end of this year, it'll be year one, and the recovery will come sometime end of year two, i.e. when growth turns positive again. Is that kind of how you're thinking of it?
Well, the markets will turn around before the economy turns around.
Sure.
But that I am saying, you know, without being pinpointed to the month, that is probably going to be a second half 2023 story. And so I think the economy will, if the Fed does, I think the Fed ultimately gets comfortable that it's killed inflation.
Final question. Where do you think bond yields go in the next 12 months?
I think that the 10-year, I think we're going to break below 2%. I think that we probably will get to 1 3/4. And I'll just say that if you're bullish on equities, you have to know that at the lows, historically, the 10-year note yield and the dividend yield tend to converge. That's when the alarm bell, that's when you get the real relative valuation support for the equity market. Well, what's the dividend yield is 1.6. The 10-year note is, call it 2.8. Well, maybe there's a meeting of the minds in between, but either the 10-year note goes to 1.6 or the S&P might have to go to, well, it would have to basically go down around 2,200 to or there's a meeting of the minds in between. But everything that I'm seeing, by the way, you need to get, if you're bullish on equities, you have to be bullish on bonds first. There's never been a recession low in equities that wasn't followed by a huge rally in treasuries. So by the way, in recessions, inflation goes down. Yes, how much? That's the question mark. But in every recession, bond yields go down. There's really never been a recession where bonds didn't make you money total return. Now, it's more challenging today in the sense that you don't have the coupon, but then again, the convexity gives you a nice capital appreciation. If I'm right on where the 10-year note's going to go in the next year, I'm not saying, I mean, you can go and buy long dated zeros, you know, or just buy long bonds. I'm just talking about the 10-year note, 14% total return in the next year. My call comes to fruition.